Hello, and welcome to the presentation for Team Malaysia. The research provided within this presentation focuses on the pursuit of penetrating the insurance market in Malaysia. Agenda. Today, we will cover a brief introduction of Malaysia. Then, we will look at the results from our SWOT analysis, which includes the strengths, weaknesses, opportunities, and threats of the insurance market in Malaysia. Upon completion of the SWOT analysis, you will be able to see a side-by-side comparison of the information gathered in the SWOT analysis. After that, we will review our proposed market entry strategy to enter the Malaysian insurance market, and then lastly, we will close out the presentation with the recipe for success. Malaysia gained its independence in 1963 when the British colonies of Singapore, Sarawak, and Sabah joined the Federation of Malaya to create Malaysia. Singapore quickly withdrew from the country in 1965. Malaysia is slightly larger than the U.S. state of New Mexico and is located in Southeast Asia bordering Thailand, Brunei, Indonesia, and Singapore. Malaysia has a population of approximately 30 million people, which ranks 44th in the world for total population, just behind Peru, Nepal, and Afghanistan respectively. The major religions within the country include Islam, Buddhism, Christianity, and Hindu. Malaysia's economy has a high dependence on exports, including oil, gas, palm oil, rubber, and electronics. The Malaysian government provides economic and social preference for ethnic Malays, which was passed under the new Economic Policy Act of 1970. The total labor force of the country includes 13.19 million people, and the total unemployment rate is just 3.1%. Persatuan Insurance Malaysia Chairman Chua Sek Guan said, "The Malaysian general insurance industry has proven its resilience once again to emerge relatively unscathed from last year's challenging economic and difficult operating environment. We believe demand for insurance protection and products will grow steadily, driven largely by individual and business needs for better protection and increased awareness about insurance benefits to mitigate risks in an increasingly uncertain world. In comparison to Thailand and Indonesia, Malaysia is an emerging powerhouse in the insurance market, with total premium in 2014 increasing 5.9% to $4.78 billion US. They continue to see steady growth and are on their way to becoming a successful mature insurance market. This is bolstered by not only their GDP, but also the government's determination to make Malaysia a big contender in the global marketplace and the increased awareness of insurance risks and benefits among consumers and the business community. In 2015, projections continue to show growth of around 5.6%, with most of the growth coming from the non-life insurance sectors. If we look closer at the breakdown of premiums between lines, auto is the clear winner, holding 47% of the market in 2012. It poses the largest premium opportunity and is also projected to show the most growth within the next 5 years. As improved awareness and new insurance regulations are passed, the penetration in this sector will only continue to grow. In 2014, the line registered a steady 5.4% growth for the year with no indication of backing down in 2015. We know they have the premium. What about their loss ratios? Overall underwriting profit increased from 2013 to 2014 from $409 million to $417 million. Loss ratios remain pretty steady at 56.7% average for the market. The General Insurance Association of Malaysia, or PM as mentioned earlier, attributed the industry's resilient performance to increased domestic demand and a greater awareness of insurance risks and benefits among the consumers and the business community. In turn, this performance drives the financial premium benefits of our proposed entry into the Malaysian insurance market. Malaysia has one of the best economic records in Asia, with their GDP increasing at an annual average rate of 7% per year for the past 25 years. The economy's 2014 GDP was just under $747 billion, making it the 28th largest country in the world. Their growth has benefited from the Malaysian government's vow to make Malaysia a self-sufficient industrialized nation by 2020, and they are actually ahead of that schedule. Many banks see Malaysia's potential. HSBC has projected them to break the top 25 largest economies by 2050 with a GDP of around $1.2 trillion, an investor's dream. The Malaysian government has continued to provide the framework for a very pro-business economy and structure. In return, Malaysia has scored very well in overall economic freedom, especially in the areas of open markets measured by trade freedom, investment freedom, and financial freedom when compared to global averages. Their work rank puts them at number 31, which is very respectable given their emergence into the world as an industrialized market economy. The Malaysian government continues to introduce new laws and blueprints in order to increase their overall investment, financial, and business freedoms, which has increased their overall investment attraction. Number 1. 2011 saw the introduction of the new financial sector blueprint, which charted the direction of the financial system over the next 10 years, with an overall objective of making the financial sector more competitive, dynamic, and to offer world-class financial services. Number 2. The Competition Act of 2010 had a huge impact on the insurance industry, with the likelihood of tariffs on the insurance premiums coming to an end in a few years. Number 3. As stated before, the Malaysian government has a very open state-oriented outlook on the economy, which has facilitated entrepreneurial activity. From an investment standpoint, they have no minimum capital required, and incorporating a business takes 3 procedures. They are also allowing foreign investment to a greater extent. Number 4. To be more specific, Malaysia's top corporate tax rate is 25%, which puts it into the middle lower half of the pack when looking at worldwide corporate tax rates. But after deductions, the local-based companies pay an average of 19% in taxes, while the multinationals pay around 17%. According to PwC, Malaysia ranks in the top 17% of countries with the best ease of payments. In addition to the already competitive tax rates, the Malaysian government is planning to cut income and corporate taxes in 2015 and 2016 respectively. On top of their lower than average tax rate, Malaysia also has the added bonus of a 0% dividends tax rate, making them very appealing from an investment standpoint. Overall, Malaysia is a target democratic country with a strong rule of law and pro-business outlook that will only benefit our investments and market experience. A firm entering a new market must focus on the socio-cultural influences of a culture, including the cost of labor, normal workers, and the role of labor unions. Fortunately, Malaysia scores well under those categories across the board. In 2010, Malaysia launched the new economic model, which aims for the country to reach high-income status by 2020, while ensuring that growth is also sustainable and inclusive. In 2012, Malaysia introduced a minimum wage set to transform the country into a high-income nation by 2020. The minimum wage set is set at $255 to $287 per month, depending on where you work. In comparison to other Asian countries, they do fall on the higher end, but overall the wage benefits are good when compared to our own company's U.S. standard. According to their Department of Statistics, the average monthly income in Malaysia in 2013 was $571, whereas the average monthly income for an insurance worker was $877. Malaysia is known for its quality labor force, and the higher than average regional incomes give it the ability to attract and maintain talent. Since Malaysia competes directly with Singapore for workers, the higher salary is justified and still lower in comparison to other nations outside Asia. Although the government has followed the trend of other Asian nations by establishing a minimum wage, their overall labor relations are seen as non-confrontational. Labor unrest in general is unusual in this country. Many of the insurance firms that have entered the insurance market in Malaysia have successfully domesticated their businesses by incorporating in Malaysia. The process for domesticating an insurance firm in Malaysia is not as simple as paying a fee and applying for a license. Bank Negara, which is officially known as the Central Bank of Malaysia, must approve the domestication of any foreign insurance firm who wants to enter the market as a domesticated player. The Central Bank of Malaysia only allows additional players to enter the market if the market can sustain or grow with new market entrants. These restrictions pose a significant barrier to entry into the new insurance market in Malaysia, and it may take an extended period of time to penetrate this foreign market. Although most of the population speaks British English as a second language, the national language is Bahasa Malaysia. Other languages spoken and written in Malaysia include Tamil and Chinese. Although British English is similar to American English, there are slightly different meanings for certain words that must be taken into consideration. Some advertising campaigns that are acceptable in the United States may be inappropriate or offensive in certain areas of Malaysia. Many foreign firms who enter the market in Malaysia have established joint ventures with local companies. This proven strategy could directly contribute to greater local responsiveness and adaptability to the market. Although the takaful market provides an opportunity within Malaysia, U.S. companies may have limited experience conducting business in this growing niche market segment. The word takaful means joint guarantee in the Arabic language. This is a form of Sharia-compliant insurance that is currently offered to the majority Muslim population in Malaysia. Once again, Bank Negara must approve the licensure of firms entering the insurance market. Malaysia has shown steady economic growth. Last year's oil price reduction, the slowdown in China, and uneven global recovery dampened economic growth by a small percentage. The World Bank forecast shows continuous growth for the country, which in turn leads to an increase in consumer expenditures and facilitates expansion in the country. The insurance industry in Malaysia is relatively small by international standards. However, with the projected economic growth, a large proportion of the population will reach levels of per capita income that will significantly increase the demand for risk and savings type products. The annual inflation rate in Malaysia slowed to 1% in January of 2015 from a 2.7% in the previous month as cost of transport and communication declined, a rise in the prices of housing and utilities, and the food and non-alcoholic beverages moderated. Over the past few years, inflation rates have been under 3%, which is lower than the average inflation for Asian nations. This provides confidence to invest in Malaysia. Interest rates have been stable in the last few years at 2.94%. However, in 2015, rates went up to 3.25% as the government felt it was appropriate given the decrease in the inflation rate. This could represent a moderate threat to the demand for automobiles, which in turn can affect the demand for car insurance. According to the Population and Housing Census 2010 figures, ethnicity and religious beliefs correlate highly in Malaysia. Approximately 61.3% of the population practices Islam. According to the Constitution, all ethnic Malays are considered Muslim by law. This is an important fact since they currently represent the large majority of the country. From an insurance perspective, this offers a huge opportunity to create a product that fits the Islamic law requirements, takaful. The Malaysian takaful market currently represents $564 million and is still dependent on conventional reinsurance due to limited capacity and the lower-rated re-takaful operators. Takaful risk is usually arranged on a facultative basis with conventional foreign reinsurers. Malaysia's first comprehensive law on competition was enforced in 2012 by Bank Negara Malaysia. This has had a huge impact on the insurance industry, with the eventual likelihood that tariffs on insurance premiums will end in the coming years. This will facilitate the entrance to the market for our insurance company. However, this will also increase the price of competition and motivate insurers to make sure that stricter underwriting is carried out. The Financial Services Act of 2013 and the Islamic Financial Services Act of 2013 have been introduced to further solidify the insurance sector's regulatory and supervisory framework. This act aims to provide the regulator with greater powers to counter future risks to financial stability in the financial sector, increase consumer protection and promote competition in the broader financial services sector, and is a step towards global trends in financial regulations. It affects the insurance sector because insurance and tackle companies holding composite licenses cannot carry on both life insurance and family tackle business and general insurance or general tackle business, limiting areas of expansions for organizations. In 2009, foreign ownership limits were raised from 49% to 70% for branches of foreign insurance companies. In the World Bank's Global Doing Business 2013 report, Malaysia moved up from 18th to 14th place overall among the 183 economies covered in the survey. Government incentives to increase foreign investment in Malaysia have eased entry access, creating an opportunity to enter the market. Competition from traditional players is increasing as global trends of consolidation and specialization are creating international insurers that are larger, better skilled, and more focused on core areas of competence. These international players will affect the performance of local insurance companies. This opens a window of opportunity for our insurance company to penetrate the local market, if we are able to deliver better performance and experience compared to the current local supply. There have been an increasing number of insurance companies penetrating the Malaysian market in recent years. Many of them have acquired local companies to gain market share. Currently, the largest tackle insurer is Etika, writing about $7 million in tackle insurance as of 2013. This number is considered small compared to the potential of the tackle insurance industry with $564 million. This is where our company sees a great opportunity to enter the market. The largest general insurance company is Alliance with 12.2% of the market share as of 2013. The above chart reflects the 10 largest non-life insurance companies currently operating in Malaysia. There is rivalry among the established companies, but there is also room to grow in Malaysia. Current insurance companies need to adapt to technological advances that have fundamentally changed the way business is conducted by removing intermediaries to help reduce cost and inform consumers about all of the different existing products offered by competitors. Insurance companies will need to meet the needs of more sophisticated and more informed consumers. In addition, the emergence of new large insurance providers will give consumers more places to choose from and more bargaining power. Global climate changes possess a threat to insurance companies. Malaysia has been affected in recent years by heavy floods. This will increase the number of claims submitted by clients. Bargaining power of suppliers. As demand for insurance grows, so will the demand for labor in the industry. Finding qualified labor to work for insurance companies may become a threat, and the shortage of labor may drive labor costs up. Substitute products. There are plenty of substitutes in the insurance industry. Most large companies offer similar suites of services. Whether it is auto, home, commercial, health, or life insurance, chances are that there are competitors that can offer similar services, and therefore this is a threat to our company. The strengths and opportunities gathered from the SWOT findings clearly outweigh or offset the weaknesses and threats. This is a clear indication that there is a great opportunity for foreign players to enter the Malaysian insurance market. The best way to enter this market is to acquire a small existing insurance carrier. Although this may be expensive up front, the strengths outweigh the investment. What makes Malaysia a great contender for this strategy? With the recent passing of the Financial Services Act and the Islamic Financial Services Act, Malaysia has become a hotspot for mergers and acquisitions, and this will continue for the next few years as firms restructure and consolidate efforts in the tackle and insurance sector. Success stories have been abundant, including AIA's purchase of ING's Malaysian business, as well as Zurich's acquisition of MAA Assurance. Compared with other Southeast Asian countries, Malaysia has a relatively higher limit on foreign ownership, which allows foreign investors to buy as much as 70% of domestic insurers. In addition, there may be more benefits coming in the future through the anticipated market liberalization through the Asian Economic Community in 2015. Overall, their merger and acquisition activity is relatively fluid and beneficial to the acquiring company. A major advantage of the acquisition strategy is that it immediately eliminates many of the cultural, administrative, geographic, and economic distance threats and weaknesses that our SWOT analysis identified. We will have instant penetration into the market and quickly obtain control over the acquired firm's office, employees, technology, brand name, and distribution networks. We will also have an already established book of business, which will include valuable information like loss data, forecasting, rate and retention, and most importantly, we will automatically be a contender in the market and have a customer base in which to improve upon. Now that we have a strategy for entry, how do we restructure our own internal strategy to make the acquisition and the launch of our product into the market a success? Overall, our core competency is to provide affordable and comprehensive auto insurance to our customer. We already have a product in place, but we must exploit the local resources to key into the Malaysian client's specific needs. Utilizing adaptation and aggregation will allow us to exploit economies of scale by utilizing our established product and then boosting market share by customizing it to meet local market needs. Thus, we can use our base product and then further tailor it to the local level. In addition, implementing a transnational strategy for office integration will also allow us to exploit Malaysia's economies while also applying coordination of methods that leverage core competencies and reconcile a mix of global and local pressures. This includes introducing the new office into our corporate culture without completely disregarding their own culture. By taking turns on being leaders in certain circumstances, we can come together and agree on who the decision maker is for certain situations and find where each group excels. On the back end, Home Office can continue to apply systems to motivate communication and collaboration between the new acquisition and existing operations. Further examples of integrating both adaptation and aggregation and the transnational strategy in our business model can come in through common IT systems, which enable integration and consistent decision-making between regional or global level offices. This also promotes mutual understanding and collaboration between our offices. Home office market development organizations will be able to communicate with the global business unit and crisscross their career paths. Overall, collaboration is one of the keys to success for both our products and worldwide offices.